So to compare apples to apples and oranges to oranges, you might want to use the number of years actually left on your home loan. Instead of entering in 30 years, enter in the number of years that remain on your mortgage. Naturally, if you extended your mortgage out over a longer time, your payments would always be lower, even if nothing else changed. So if you have a 30-year loan, but would have been paying on it for 3 years, you would use 27 years or 324 months on your mortgage calculators. Using this method, your payment amount will be higher, but you'll finish paying as originally scheduled. Do you think that payment is still too high? What would be your payment if your interest rate was 0%? Of course, 0% isn't going to happen, but we can dream a little, can't we? Go back to your mortgage calculator and change this percentage to 0. Write down the monthly payment amount and once again, add the amount of the impound payment. Sometimes a lender will offer a temporary payment that has an interest rate as low as 0% or even lower. However, you will pay a high price for this temporary reprieve. That is because although the loan modification paperwork may not say this, the lender will add on any difference between the payment you would have made under the unpaid amount onto the principal balance of your mortgage. They may even be doing this when they lower your interest rate to reduce your payments. Once again, lenders will find any way to make a buck. However, unless you press them for an answer, you may never know what they are doing. This trick is called negative amortization. This was common in the high-risk loan mortgages that had the so-called teaser rates that later inflated so much that homeowners almost always lost their homes when the new higher rate kicked in. Essentially, lenders took a gamble that borrowers would be able to pay the higher rates or that they would make money by foreclosing on a house that was worth much more than the amount owed. Now, if you don't plan on keeping your house for very long, take advantage of the negative amortization because it can give you a low payment. But if you want to permanently stay in your home, be aware of the high price you'll eventually pay to have a negative amortization loan. Now that we've seen what Uncle Sam will pay your lender to modify your loan, and we've seen the kind of payment you might get with a modified loan, after factoring negative amortization, you can see what loan modification looks like, warts and all. After spending more time than you probably ever want to with a calculator, hooray! Now you're ready to tackle a pile of paperwork. Don't start crying. Filling out the application is actually the easiest part of getting a loan modification. You can either call your mortgage company to have them mail you a copy, or they might even have it on their website. Don't submit an incomplete application because they'll reject your application and probably have a good laugh about you at the office. So it begins with the most important scavenger hunt of your life, getting all the required documents. Each mortgage company will require a different set of documents. Some companies will want to see 3 months of income records. Some will want 6 months. Some will want 2 years of tax returns. Some will want 4 years. Instead of the tax returns themselves, the mortgage company may demand an IRS authorization instead. Financial documents will be required with any loan modification application. Details count, so follow all their requirements to the letter or you've wasted a lot of your time with nothing to show for it but paper cuts. Ouch! Each group of documents should be organized with a cover sheet. The cover sheet should describe the nature of the documents you're submitting in an organized fashion and should state the number of pages. One group for tax returns, for example, or wage records, proof of medical hardship, etc. Also, briefly describe why the documents are being submitted. Package it so it's simple and understandable. Assume that the lender is a blindfolded 4-year-old, or more likely, someone who speaks absolutely no English. The typical documents your mortgage company will require are 1. A hardship letter. 2. Your income records, which may include pay stubs, retirement benefit statements, or an unemployment award letter. Tax returns and an authorization to obtain your tax transcript directly from the IRS. 4. Bank account records. Preparing a hardship letter can seem about as easy as climbing Mount Everest in a pair of flip-flops, but don't fret, because some mortgage companies will actually supply a handy form letter. Just be careful when it comes to submitting a hardship letter. If you overstate your case and say you have a financial situation which is hopeless and beyond repair, if you really break out in tears and violins, the lender will reject your application. Why? Because they'll think you're beyond hope and that you can't afford to pay off the house even with reduced payments. Remember, the government says that you can't afford a house that costs more than 31% of your income. And if there isn't some kind of hardship to show that your income is smaller, then your application may be rejected because they'll think you make too much money to qualify for a modified loan. Save this sad and gory details for your friends at the bar. The lender isn't going to be moved by long, woeful tales. Just let the facts make your case and back up your facts with your documents. For example, if your income has dropped or been lost due to a job loss, reduced work hours, pay cuts, or a drop in self-employment business earnings, say just that. Describe the problem a bit, but keep it brief. Remember, you're just another piece of paperwork to the lender. Then refer the lender to the attached documents with the handy cover sheets. All the lender then has to do is refer to the sections and compare the pay stubs you've included to show how your numbers have now been reduced. State briefly what you're doing to bring your income back, but don't be too optimistic. Now here's another example. Your hardship letter may center on how your household finances have been hurt by a death in the family, a serious or chronic illness, a permanent or short-term disability, the adoption of a child, or assuming care of an elderly relative. Again, don't make it a soap opera and state how long you expect it to take before things improve. Refer the lender to your paperclip section called Changed Financial Circumstances, which in this case might include a death certificate, medical paperwork, or an adoption certificate. Want another example? Okay, it might be your expenses have increased because of a higher mortgage payment or higher medical or healthcare costs due to an uninsured out-of-pocket expenses due to theft or natural disaster. Or you're facing higher utility bills or higher property taxes. Again, give a little detail and spare the violins. You're not going to get any tears out of a lender. Refer the lender to your clearly labeled backup documents, in this case the utility bills, property tax bills, and so on. Finally, your reason for hardship may have to do with overwhelming debt. Credit cards or home equity loans include copies of the credit card bills, your credit report, or loan documents to show where your money is going. You might also want to include a statement about your savings. Specifically, you might want to say you don't have enough savings to continue to dip into in order to make the mortgage payments. As long as you've got the documents to back up your case, you should be good to go. Finally, whatever you do, don't make threats such as threatening to walk away from the mortgage unless your lender reduces the payments. The lender will most likely shrug it off. Besides, your mortgage company probably has insurance to cover their butt in the event of a foreclosure. You're in about as good a position to threaten as a bug threatening the windshield of an oncoming semi. Guess what? At this point, there's a light at the end of the tunnel. You're almost done preparing your loan modification application. A few other tips. Make several copies of the application so you have spares in case of a mistake. Print your answers clearly. No chicken scratch.